you to this particular session that we shall be having now. Our session will be based on a part of your course that is called as equity markets. It has been coded as MMPF 007. Now, in equity markets course, we have seen what are the financial markets, what are the primary market and the secondary or money market, who are the participants, who are the regulatory authorities, as well as the various kind of rules and regulations that are adopted for the securities. Not only that, we also saw how we can judge a particular security. When we say judge, that means what should be or what is the value of a security. That is the true value or the intrinsic value of a security. Security can have two prices. One is market price, another one is determined by experts or determined by analysts or traders. Now, the price that is determined by using the various kind of fundamentals, in other words, the earnings, the company's profitability, the company's existence, performance. That means the basic pillars on which the company is built up. Taking that, we try to derive what is the intrinsic or the true value of a security. That is called as the fundamental analysis. It will tell us what should have been the price of a particular security. Now, what we do, we compare that intrinsic price of a security with the market price. Suppose if 10 rupees is the intrinsic price of a security, however, it is being sold in the market at rupees 15. What do you understand? Now, the security which should have been sold in the market at its true worth or true value or the intrinsic value, that is 10 rupees, is currently selling in the market at rupees 15. That means it is a case of overvaluation. That gives a scope to make abnormal profits out of trading in the securities. Another school of thought also we saw, where we decide on the timing of the transaction of securities. When we say timing, we say when to buy or when to sell a particular security. For that, we use various kind of charts, the oscillators, candlesticks, etc. Using these tools, we can very well find out when is the time to buy or when is the time to sell the security. Now, this timing, the way we determine or the chartists use it, we call this as technical analysis. So, both fundamental analysis and technical analysis are important for transacting securities. That also we have covered up in our course. Then we also saw in some of the sessions that the securities, we can say, what is the risk and return of a security. When we are going to purchase a security, how much risk is it is containing or how much is the expected return it is giving. Apart from that, we also tried to see why we need a portfolio of securities, and when we construct a portfolio, what are the return characteristics and risk of that particular portfolio that we have created. Now, is our portfolio the best one, the optimal one? Now, in order to answer that question, we also went through something called as optimal portfolio, which was taking into account the satisfaction level of the investors. So, wherever the efficient frontier of portfolios forms a tangent or gives a tangent point to the indifference curve or the satisfaction curves of an investor, that point is the optimal portfolio for a particular investor. That also we saw. Now, how we can visualize the market as a whole? That is also a question in front of us. Suppose, for example, let us take our practical day to day life. All of us, we depend upon purchasing household items, maybe on a weekly basis or fortnightly basis, or in most of the cases, it is in monthly basis. Suppose monthly basis. We usually hear from various people, hey, the prices of the items, grocery items, are increasing day by day. So, how do we know that all the items are they increasing day by day? Suppose we have five items that we need for our day to day operations at our house, that means kitchen operation. Now, those five items they will be having either the prices that is increased as compared to the previous period, or prices which has come down in a previous period. So, if somebody asks what is the impact of your kitchen expenses when we compare with the past period, so the way we try to answer it is not that A has increased, B has fallen, C has increased, D has increased. We want a generalized single point answer. So, what we do there? We take a combination of all the increases or decreases of the securities, which will try to say whether the overall impact is positive, that means increased, and by how much, or the overall price has fallen down by how much. Suppose, for example, let us take or consider the last month's expenditure on household grocery was rupees 100. This month we have purchased the same five items of same quantity, and we are finding the overall price has become 105. That means taking all the things into account at the same time, it has become 105. So immediately, last year period was 100 rupees, this year period it is rupees 105. When I compare the difference, that means this month, in general, the average increase in prices of the grocery items is 5%. So instead of telling all the items whether it has increased or decreased, I can tell in a single wording, that is 5% increase. That particular way of expressing what I have done. Now, first, previous year, whatever is the expenses, I took it as 100. I made it equal to 100. Now, in comparison to previous period, whatever is the expenses, I try to express that in terms of 100. That is, suppose 105. So, we are trying to have a certain base, that is past year period, that was 100, and This period we are trying to express in the past period's terms of 100. This 100 or the 105 are called as indexes, or the process is called as indexing. Now, how we can construct an index which will try to help anybody interested, be it investor, be it trader, be it regulators, be it government, be it a layman, be it a student, to understand the market as a whole. So for them, we use a single term because in the market, suppose Bombay Stock Exchange, you may be having thousands and thousands of securities listed over there. We cannot tell each one's increase or decrease to somebody to make them understand the market. Or if we tell them also, they will not understand what we are trying to convey them. Instead of that, we try to convey them in a single figure. That BSC has increased to 20,000 rupees. Or last period it was 20,000 rupees or 20,000 points. This period it has become 21,000 points. That means the market has increased from 20,000 to 21,000. So this indexing, how it is used in stock markets, what are the widely accepted indexes in Indian context, as well as the world context, we shall see in this particular session. Now, with a small example, I was trying to tell what we understand in general by index. So, that index for stock market or the stock market indices serve as benchmarks for evaluating market performance. That means if I track the time can be on hourly basis, every second, every minute, every day. You can take the time frames. Now this index, suppose 10 days back it was here, and if I join the points, we can easily find the market is moving upwards. This index is reflecting the market. So immediately one can know from the index value when we plot them that whether the market is performing upwards. Upward means whether the prices are getting higher and higher. That means if it is moving upwards, we say it is bullish. And if the prices falls, we call it as, from the word bearish. So we can evaluate the market performance as a whole by using the index. We can also track the investment returns. That means the investment returns more or less are affected by the market returns. Now, The market returns, if they are bullish, then our returns will also be increasing, and vice versa. And the third point that the stock market indices serve is the overall health of the economy it tries to tell. Economy is healthy or growing, we can say, when the market is growing. That means the investment in stocks, securities, etc., are increasing day by day. So that will reflect the health of the economy. Now, understanding the construction of indices is essential for investors, financial professionals, and anyone interested. Now, how this index is constructed, that if we can understand, then we can know or comment on the workings in more detail. Otherwise, by looking at the thing, we can only generalize whether the market is increasing or it is coming down. Now, it is essential for investors, financial professionals, students, the government agencies, regulators, Reserve Bank, etc. etc. Now, these indices help in analysis and interpretation of stock market data. Now, how does it help? Now, suppose let us look at a particular period. Even though the market is increasing, this period the market is coming down. Even though the overall trend is increasing or bullish, however, in the short term, in the 2 days time period, the market has fallen. You can analyze this portion also. It is a continuous increase, a continuous bullish phase for the 4 days we have experienced. So we can understand the market very deeply, whether the overall performance of the market is bullish or bearish. Now, within the bullish phase, are there any downfalls? Or within the bearish trend, are there any upward growth, etc.? Now, how we can define the indices? As we have seen up till now, the dictionary says a sign or measure of something. We started this particular session when I took the example of the household grocery. Now, instead of telling all the items whether they're increasing or decreasing the prices of those items as compared to the previous period, what we do? We try to measure in a single figure what is the overall increase or decrease in the particular thing that you are discussing, that is the household grocery. So we say indices are a measure of something or anything. What is investment? Immediately, as we have seen up till now, a hypothetical portfolio of securities. Imaginary, hypothetical means imaginary portfolio of securities designed to represent an asset class, market, or market segment. So indices can be for asset class, can be for the market as a whole, or for any particular market segment also. For example, you have indices for equity shares or equity stocks, debt securities, gilt edge securities, etc. or you can take the market as a total aggregation of all the type of investment that we are having, or any kind of market segment. Sometimes you will be hearing words like large cap, small cap, mid cap. That means the market has been divided into three categories if we are using these three terms. There are many other market segment ways. Large cap is large capitalization. That means according to the volume or the capital of the organization. You can have medium also, you can have also low. Now these indices are the barometer of the market. Now as the wind pressure is measured, similarly the market pressure is measured through indices. So we call it as a barometer. Now when we are talking of the history part, indices were introduced back in 1896 when Charles Dow first published the Dow Jones Industrial Average. So now we can say that it is already 130 years back. So Dow Jones Industrial Average is the oldest one of the indices that has been used for securities market. Over the time, index developed by Henry Barnum Poor and the Standard Statistics Company, we use na S&P. We say one of the biggest organization in the financial side of the world. So Henry Barnum Poor and the Standard Statistics Company, they joined together and they formed the predecessor of the US S&P 500 index, one of the most widely used along with Dow Jones Industrial Average. Now, what are the purpose of the indices? The purpose are, first of all, they are market indicators. That means indexes try to generalize the movement of the overall or all the securities in the marketplace into a general format. How does it show the market? Now, if on a graph we try to show, then we'll find there is a upward trend in the market price of the securities, and the market is in growth phase or bullish phase. Economic indicators. Now, index is increasing. What it means? Now, more and more securities are demanded as compared to the supply. So, thereby, what is happening? The prices of the securities are going upwards. Or, in other words, index is moving upwards. So, when more and more investment is being channelized into various sectors of the market, we say that the funds are being mobilized from unutilized state to the needy sector, that means the industrial sector, etc. That will lead to growth in the industries, growth in the infrastructure, growth in the service sector. So we say indices try to serve as economic indicators. Third case is benchmarks. Now, what is the benchmark? Suppose a particular company X is there and it has securities listed in a particular stock exchange. In the past period, X value was 100 per share, and the market index was standing at, suppose, 1000 points. This is last period. Now let us see current period. What do we find? X has become, and the market index now we see that share has increased, the share price has increased as compared to last period, and the market index also has increased as compared to the last period. Now, what is the return of X security? Now it is 110, that is 10%. We can calculate and check it. Second is, what is the return on market? We find the index of the market divided by that gives me a figure of 20%. Both have increased. Can I comment on the return of security X? Security X, yes, definitely the income has increased, but it is not according to what the market has overall seen as the increase in income or the return on the or on an average. So security X is falling behind in comparison to the change in the market return. So market return is considered here, or the market index is considered here as the benchmark, to which we compare the securities return in order to know whether it is performing better or it is performing badly. Now, another purpose of indices are index linked investment funds. Many times, investment funds are the avenues through which small time investors they try to have their money invested, and these investment funds, if they are linked to index, then we say that they are linked to the market. Whatever the market is getting as a whole, whether it is increase or decrease, that also will be reflected in the fund's return. Sorry. So we say that yes, investment funds they use the indices or link their funds to the index so that they can know whether they are getting the returns according to the market or not. And finally, the market analysis. One can easily track the indices over a period of time, maybe small time periods, hourly basis, minutely basis, up to yearly basis or decades, and we can see what are the overall changes in the market positions. And let us understand how indexes are constructed. What is the methodology behind it? So, when we say index, suppose think of a particular stock market, suppose Bombay Stock Exchange. Let us assume that not less than 5,000 securities are listed in Bombay Stock Exchange. Let us assume that 5,000 securities are listed in Bombay Stock Exchange. Now, shall we take all the 5,000 securities which are listed and their performance so that we can construct an index easily? The answer is no. Because many companies are there which do not perform well. They are only listed because they have to adhere to the regulations. But companies are there which perform very well. So, companies, those who are performing very well, they try to reflect the image of the market. That means market, whether it is moving upwards or it is moving downwards. So when we are talking of selection criteria for constituent stocks, that means out of 5,000 total securities, suppose total securities here is 5,000 securities. Now, instead of taking all the 5,000 securities for calculating the index, what we do, we take certain number of securities, those who are performing on a regular basis. Now, which are the securities? What are the securities that have to be taken as constituents for the index? So, we have certain criteria. What are the criteria? First is market capitalization. Now, what do I understand from market capitalization? Now, suppose let us take a company A or company. Now, it has 2,000 equity shares, and each equity share is being sold at, rupees 100. So what is the total value of the company's shares? It is 2 lakh rupees. That means if I sell off all the securities of the particular company A in the market today, I will be getting a total value of rupees 2 lakh. That means my market capitalization or the market's worth for my securities is 2 lakh rupees. So according to market capitalization, we can select the stocks, the first selection criteria. Another selection criteria can be liquidity and trading volume. Now, what is liquidity? Liquidity is the ease at which we can sell off our securities. What happens? Suppose we have four or five companies equity share in our hands. Three belong to big corporate houses who have a reputation of performing well over generations, and they are expected to continue their operations forever. Another company X is there whose security I have purchased last year, but I am finding that the company's reputation is not there in the market. It is not performing well, and it is only being listed due to the regulatory conditions. So when I need some money out of sales of this particular X company shares, I will take it to the market and sell it. But buyers will not be readily available. So when we say liquidity, liquidity is the readiness with which one can convert the securities into cash, and also the trading volume. If there is no liquidity, trading volume also will be coming down. That means more and more securities will also not be transacted in the market. So higher liquidity, higher trading volume has a greater impact on the market as a whole. So that can be a selection criteria for being a constituent stock. Sectoral representation. Now we have different sectors. When we say market, we can generalize that into industrial sector or service sector. Now, under industry, we can have sectors like iron and steel, cements, the infrastructure, etc., etc. All the industrial sector will come up. In service, also, we can have hospitality, we can have uh, hospitals also, we can have educational, etc., etc. Now, is the index trying to reflect all the sectors as a whole? That is important. The index should try to showcase or try to show the impact of that particular sector in the index. Another one is industry classification. Now, within the sectoral representation, you may be having different industries. Industries can be uh, high investment groups or high investment industry, medium scale, and small scale also. So, how each category can be shown, that also forms a selection criteria for constituent stocks. Trading venue. Now, where are the stocks being traded? That also becomes a selection criteria. Now, this selection, whether it is according to experts committee or it is having some kind of rules, so that if any security passes through all the rules, then it will be taken into index construction. Second thing that we see under index construction is assigning weights. Now, before understanding anything, how do we know the weights or the importance? Suppose three items are there, A, B, and C. All will not be having the same kind of market caps or market capitalizations. Or if A is a large scale, B and C are small scale. It may so happen that A being of large scale, it will be having large number of securities and large number a price also will be higher, maybe higher. So they will be affecting the index to a greater extent. So thereby creating some kind of biasness. Whereas small scale industry, even though they are performing very well, they cannot match the large scale industries in terms of market capitalization. So we need representation of both large scale and small scale. So according to their importances, we try to assign them weights. Suppose weights assigned to small scale is 2, large scale is 1. What I understand? Now, whatever is the market capitalization, but small scale have twice the importance as compared to large scale in terms of performance. So when we use weights or importances along with market capitalization, that can also become a weight. Second is price weighted. Now what happens here? Now we only take, instead of market capitalization, we take only share price. That means suppose A is rupees 10, this is rupees 5, this is rupees 2. So here we only take, instead of market capitalization, the market prices. They will form the ratio for the weights. Similarly, equal weighted. That means all will be considered as having a weight of 1. All will be treated equally. And also sometimes we can go for fundamental weighting. That means according to the earning capability, the profitability, the management, the operations, etc., over a number of periods or successive periods, we can have the fundamentals of the organization, and that can be used as weights. Now, while assigning weights, some points have to be considered. Now, what are the points we try to generally consider? Now, first of all, the weight should be a proper representation of the market value, because we know market value usually comes from the demand and supply pressure, or from the way the company is having its operations. Second is, it should try to reflect, try to show, try to judge the investor sentiment regarding the market. Whether the market is going to be favorable or it will be going to be unfavorable. That means whether there will be growth or there will be downfall. Many times we have seen before budget or during certain events, the market indices that usually crops up in the news channels, newspapers, etc. They show either a increasing trend or a downfall. That means it is showing the reflection of what is going on in the investor's mind regarding the particular event. Also, we have to consider the index performance impact. How well the index is performing, whether it is trying to show the market in a proper way or not. Another point to be considered is sectoral concentration. Usually, what happens in some industrial sectors, big industries are located where the investment is very huge. So, naturally, the number of shares or the value or the capitalization will be very high. So, if we try to focus only on this very high capitalization companies, other sectors may be ignored. Their performance will not be reflected in the index. So, while constructing index, we should try to avoid sectoral concentration. It should be spread over all the sectors. It should track the market trends. The index should be constructed in such a way that it will try to judge the movements in the market, that is, whether it is upwards or downward movement, in a proper way or to a greater accuracy. We cannot say that it will be 100% accurate, but we can say it will be up to a greater accuracy. Now, in index construction methodology, we have three things. Three basic things have to be done. One is, we choose the calculation method, whether it is the market capitalization, whether it is price based, whether it is experts' opinion, or some rule based like this. The calculation method has to be taken up. Second is, regular rebalancing should be done, because the market capitalization or the security prices of individual securities or the sectoral performance of the individual securities, they are affected or influenced by the investors, whether it is investors analysis or through investors the mindset, that means sentiments, the prices of the security will be changing. That also includes the securities that have been included in the index. So after a period of time, what will be happening? Na, uh, the price of a security, suppose included in the index, has fallen down. In that case, what will happen? Now we have to look at whether another security is now eligible for to be included in the index. If the answer is yes, we have to rebalance the index. Whether the index weightages have changed. If it has changed, then what is the new weight we have to assign? So we have to rebalance the regular or in a regular manner. Third thing is index maintenance. Whatever index we have formed, it should continue. It should have a proper base and it should continue for a fair length of time or for ages. Like Dow Jones Industrial Average, it has continued for around 130 years. Similarly, indexes are constructed with a view that it will be maintained and it will run successfully over time periods. Now, let us have a look at some popular indices that are widely used in all over the world, particularly US and the United Kingdom. Apart from that, we may also will try to have a look at some of the popular indices in Indian circumstances. Now, the first popular indices or index that we shall see is that is from the US market, which is uh, visualized as a representation of the world economy, that is Standard and Poor 500. S&P stands for Standard Statistical Company, P for poor, the person, Barnum poor. 500 means the number of securities that have been listed in the US market. Out of that, 500 have been selected. Now, this Standard and Poor 500 represents the performance of, as we said, 500 large cap US companies. Large cap means large capitalization. We saw the market capitalization, number of equity shares uh, available into the market price. That will give us the uh, market capitalization. So large 500 are taken from various sectors for construction of this Standard and Poor 500. It is the benchmark of the United States of America capital market. Some of the details of that is constituent selection. One of the most important thing, how these 500 eligible stocks are selected. Now the 500 eligible stocks that we saw just now are large cap US companies. They are having, or those who having a market capitalization of at least $8.2 in billion terms, $8.2 billion. They are financially viable and meeting liquidity requirements. When we say liquidity requirements, then here we are talking of the ability of the securities which can be made or converted into the cash format, or liquidity requirements here in the constituent selection. The company's debt equity or the asset to liabilities should be maintained in a proper given format or for benchmark. It is market capitalization weighting. What we do here, now we take all the 500 companies according to their market capitalization, we assign weights in a proportionate manner. Second is, it is a float adjusted market capitalization. Now what is float adjusted? Now when suppose 100 securities are coming to the market, 100 securities, out of this 30 are held by promoters, 20 by government and FIs, remaining 50 by investors. Now these shares are usually not traded in the market. What are traded or being offered for trade? Now the 50 by the general investors who buy it or sell it according to their needs. This 50 is the free float. So we have to adjust the market capitalization according to the float. A regular rebalancing is done along with sectoral diversification, and it is a total return version. We know that total return comprises of two portions. In some previous section we have seen total return comprises of capital gain, that means the change in price, plus income, yields. So we take the total return version. As we said, the first and the foremost index or the index that was used in all over the world 130 years back around is the Dow Jones Industrial Average, DJIA, or simply Dow Index or Dow the index. It represents the performance of 30 large publicly traded in US companies. It is also a benchmark of US capital market. And looking at the details, its constituents are, it consists of 30 blue chip companies selected by the index committee. Blue chip companies are those which are having a very high price for their securities in the market. So index committee selects these 30 blue chip companies for the construction of the index. Here, total return is not taken for weighting, but only the change in price or the capital gains are taken for weighting. It is a limited sector representation and it is a price return index. Similarly, in London, we have FTSE 100, that means Financial Times Stock Exchange 100 Index. This is also based on market capitalization and it promotes diversification. It uses both price return and total return. Coming to India, Almost all of us have heard or used the term Bombay Stock Exchange Sensex or simply Sensex. So it is the index of Bombay Stock Exchange where 30 stocks from various sectors according to the eligibility are used using free float market capitalization. And last but not the least, the most popular nowadays also Nifty, National Stock Exchange 50 stocks are taken where free float market capitalization is again used. So BSC Sensex and NSE Nifty are the two most widely used in India for representation of the stock market. Now, with this, we shall end our session on index construction and some of the popular indexes across the world and India. Thank you.